the USTR statement about talking about structural changes in China or anything on reciprocal import boost from U.S. goods. So really it seems to be falling a little bit short of what we had expected.
Well, a very vague statement, as you suggest there, from Chinese officials. As you say, we were awaiting their response, their official statement. Now we have it. Not many details, by the sounds of it, in their statement. And, of course, the Chinese are keen to be seen not to lose face in these talks with the US. They want to be able to convince their US counterparts that they're ready to make deals and to put in place some changes to assuage the concerns out of Washington. But they'll also want to be able to show to their domestic audience that they're not bending over backwards for the US, and that, in fact, they can extract some concessions from the US side as well. What we're looking for in terms of timetables, of course, we've got that expected conversation between Liu He and Lighthizer, as I say. Then on the domestic policy front here in China, we're looking at a central committee meeting possibly happening now, January the 19th to January the 22nd. That's according to some of the analysts looking at this, given that there have been some changes at the local legislature structure and system here in China. Some of the regional governments changing up some of their dates. It seems like the calendar's being opened up for this crucial meeting of China's top 200, approximately 200 Communist Party officials, members of the military and members of state-owned enterprises towards the end of January. And it's at these meetings, central committee meetings, that proposals are put forward that can be quite consequential. We had, of course, last year the proposal from a central committee meeting around scrapping presidential term limits. So it's something that's going to be watched very closely. It had been expected to take place towards the end of 2018, and some experts that we've spoken to say that the fact that it's been delayed points to division within the ruling party here as to how to tackle the economic slowdown and the trade war.
Tom Mackenzie, our China correspondent in Beijing, thank you. Joining us now from Hong Kong is Rabobank Head of Asia Financial Markets Research, Avery. Michael, and you probably heard right now we're discussing the response from the Ministry of Commerce in China, describing the talks as broad, deep, and detailed, but really not a lot in terms of the concessions that potentially China could make as the USTR seeks these fair and reciprocal and balanced trade relationships with China. What is your base case scenario right now for how these trade talks will unfold until March 1st?
Well, we have to remember that from what we've seen over the past few days, the primary focus from both sides is, God forbid, the equity market should go down. That's all that anyone's really interested in. So we're seeing the most positive possible spin put on incredibly thin gruel, where we've really had no particular new development whatsoever. China will buy more gas and soy. We've known that for months and months and months and months. What we want to see is something new on the structural side. And, the news reports are showing nothing really has been achieved there whatsoever. But nonetheless, it's all being wrapped up in positivity because, as I said, God forbid the equity market should go down. That's the end of the world.
Yeah, Bloomberg has learned that President Trump does want a trade deal with China as soon as possible in order to boost the markets. But when it comes to the U.S. markets, it seems that the Fed tightening and what will happen this year in terms of rate hikes is as much an important component of where the markets are going, if not more. What happens to Asian financial markets? How important are these two elements, and which one is more important?
Well, I would say the Fed on balance, to be honest, because they impact absolutely everyone, everywhere. And on that front, too, again, it's all about, God forbid, the equity market should go down. Because if you rewind back just 6-7 weeks ago, the Fed were absolutely confident that the US economy was in a sweet spot, that they could continue to raise rates and that everything looked great going forward. Now you have one Fed speaker yesterday saying the next move could potentially be a cut as much as a hike. What the hell has happened just in the past few weeks, apart from the equity market going down? And the answer is nothing.
Well, I mean, I suppose the question is then, is this a change in tone from the Fed, or are they as data dependent as always? Or is there a sense that despite not wanting to follow in the footsteps of Greenspan and Bernanke and Yellen, that we may yet get a power put?
Well, I think we will, and they're not data dependent, they're equity market dependent. That's become blatantly obvious. Can we all stop pretending they're data dependent? They're not. They're data dependent as long as the equity market isn't doing anything negative. And as soon as it is, that's all that matters. Let's be honest about it.
Michael, I want to switch to what the PBOC is doing, of course, kicking off the new year with a triple R cut and, more, I guess, lower level stimulus measures already in place there. There's an argument that the PBOC is doing too much, right, in terms of it's trying to juggle all of these objectives to do with employment, to do with currency stability, economic growth stability, price stability as well. Something's got to give. What do you think that should be?
Well, from what we can see, near term, it's likely to be debt, and that they're going to allow debt to blow out once again. I'm sure the PBOC will be buying everything left, right and centre and doing their own version of QE to prop up growth. That seems to be a no-brainer to me. But then the second thing that will have to go as a consequence, whether they like it or not, and despite all the denials, which are, of course, standard practice in China, will be the currency. Because if they're going to do some kind of QE to prop up growth, the currency is going to go through the floor. And I'm just waiting to see when that inevitability is finally delivered to us.
And right now on the Bloomberg, we are seeing the Korean Central News Agency, the latest comments. Crossing the terminal, North Korea, Kim Jong-un reaffirms commitment on denuclearization. China's Xi Jinping said North Korea's requests are reasonable demands, according to the Korea Central News Agency. Of course, these trade talks between the U.S. and China really again seem to be somehow linked to North Korea developments. Is this a positive or a negative in terms of finding a resolution on trade talks and the relationship between the U.S. and China?
Well, it depends if you take a realistic long-term view or an artificial short-term view. Because if you take a realistic long-term view, these trade talks don't matter in the slightest. Because what's actually going on is a power struggle for the 21st century between China and the US. Everyone kind of admits that, but they don't want to actually say it on camera too often. And this trade deal basically is just window dressing in the near term in terms of what we're going to do vis-a-vis the equity market over the first half of 2019. Even if we get a trade deal, do you seriously think that the US and China are going to find agreement over the South China Sea, for example? I don't. Or what the US role is in Asia-Pacific relative to China's? I don't. So really, as I said, this is just window dressing. But Korea does show absolutely that trade cannot be separated from geopolitics. They are all part and parcel of the same bigger picture.
So, Michael, what's the best case scenario if you, like many other people, and I have to say I'm pretty convinced by the argument that this is the big strategic tension moment of our time and it's going to be going on for not just months but years and decades to come. What's the best case scenario in finding, I guess an easy détente so that trade doesn't get disrupted, so that the global economy can continue to function while these two superpowers try and work out where their respective positions are in the coming decades?
Well, as with everything globally at the moment, the best case scenario is we kick the can down the road for 6, 9, 12, maybe 18 months. That seems to be the best that we can ever do. That's a buying opportunity across various different markets if it happens. Have we actually solved any problems? None whatsoever.
Michael, always so optimistic and bright to have you here, particularly at the start of this new year. Michael, really appreciate your views and insights as always. Rabobank, Head of Asia Financial Markets Research.